Let me ask you something. If I offered you an investment with zero risk of losing money, how much return would you expect? 2%, 5%, or even more? This isn't just some boring finance jargon. If you mess this up, your stock valuation, bond pricing, and even your retirement plans could go wildly off. The risk-free rate is the return you'd expect on an investment where there is zero chance of losing your money. Sounds perfect, right? But here's the twist. In the real world, there is no such thing as truly risk-free asset. So, what do we use? US Treasury bills, especially short-term ones, like the 3-month bills. They are considered the closest thing to risk-free rate. Why? Because the US government has never defaulted on its debt. But that's not the whole story. People hear government bonds and they think that it's the safest thing. But remember, Greece in the Eurozone crisis, investors holding the safe bonds were sweating bullets. So we have to be careful. If the market thinks there is a chance of default, we should make a tiny adjustment. Now, here's where it gets international. Trading in euros, use German bonds, and dealing in yen, use Japanese government bonds. Just make sure you are picking the most stable bond in that particular currency. And one more pro tip. Match the maturity of your cash flows. Like if you are using 10-year cash flow, use the 10-year bond rate, not the 3-month table, right? So, why should you even care about this? Because every single valuation model starts with the risk-free rate. Whether you are analyzing stocks, pricing bonds, or even estimating a value of a company, it all builds on this number. Get it wrong. If you overestimate, you might pass on great investment. Underestimate it, you are walking in the risky territory without even realizing it. So let's wrap this up. Risk-free rate is the starting point. Not all government bonds are risk-free bonds. Check your currency's credibility. Match the bond's duration with your investment horizon. And for countries with default risk, adjust the rate. Thank you.